including, let's see, what am I looking for? The probability of expiring. See, what happens is when you purchase an option that's in the money, you have a much greater, we're looking at this column right here, the probability of expiration, a much greater probability that that option will remain profitable and of some value the third Friday of the month based on its current stock price. As you move out of the money, the market makers are saying, you know what? This $105 option only has a 3.91% chance of being worth anything at all by the third week of May. Doesn't that make sense? It's currently about $20 away from the current price of the market. So the market makers are saying, look, you know what? We're only going to give that a 4% chance of being actually worth anything. That's why it's so cheap. You know, it's a very, very cheap option. But if you were to purchase that for 20 cents and IBM were to take a dive and fall below $105 or even get to the point where it's at the money, the at the money options are selling for $1.65. Well, your option that you purchased for 20 cents, and we can see that a 20-cent option is only $22.95, is now going to be worth $1.65 or $165. So you can see that, you know, you can buy an option for 20 cents, and in real terms it's $20 because you have to multiply it by 100 to get your real cost, can easily be worth $1.65 or $165, which is an incredible return on investment. And there are a lot of people who speculate that, you know, IBM may drop that far, and that's why they buy these options. But it doesn't have a very good chance of being worth anything at all. Now, IBM stock does fluctuate. There's no doubt about that. In fact, if we take a look at a chart of IBM, let me just bring this up for a second. Let's take a look at IBM's chart. You can see that IBM back in February, right around, maybe this is January here. Let me take a look. Yeah, let's go back. This is January right in here. In January, let's say around the 11th, IBM was selling it around $98, right down in here. If you thought the potential for IBM was to go up in price, you could have purchased an at-the-money call option on IBM when it was right around $98, probably for around, let's say if you purchased the February expiration options, probably right around where the current May options are. So maybe around $1.65, or let's see what they were selling for, $2.80. So let's say you bought a call option for $2.80. Well, from that time until the third week of February, in the third week of February, IBM was trading for right around $106. So the difference between $98 and $106 is approximately, if I do my calculations correctly, $8. So IBM rose in price by $8. Well, what would happen to that contract if you bought it for $2.80 and it went up $8? Well, it's going to be close to $10 in price because, you know, it's gone up almost $10. So it's going to be worth $7 or $8 minus the $2.80 that you paid for it. So you're going to make a profit of about $5. On the other hand, what if you thought because IBM had been going down in price, you thought that IBM was going to continue to drop, and you bought a put option for $1.65, and the price of IBM continued to go up and up and up and up, what then would happen to your put option? Well, your put option would go farther and farther and farther out of the money as the stock price continued to increase in price, and the market makers are going to value your options much lower because now it is so much farther away from the price that you actually bought it at. And the fact that it would have any value at all before the expiration of that option would be extremely low because it has moved so far away from the actual price that you purchased your option at. So if you purchased it at $1.65, the chances are if it moved $8 away from you and it increased in price, well, you know what? If you purchased your put option at 100 because IBM was trading at $98, well, now if the stock price is up around 120, your option is only going to be worth 10 cents. So instead of making $150, $160 on your contract, you've actually lost $150 on your contract. And not only that, but the closer you get to expiration, the longer it takes for IBM stock to move towards your strike price of your option, the less value it's going to have. Because remember, in our illustration of the person who purchased an option 90 days to purchase your house for $1 million and gave you a $500 premium, the person who sold that contract to you now realizes that, hey, guess what? You know, maybe you purchased that option 90 days before the expiration. Now it's only 30 days before the expiration. Well, there's less probability that the stock is actually going to be trading anywhere near $100 again because now it's $124.